Hi, folks. Dan Bird here with the Daily Scan on February 19th. And this is options expiration week. So I'm going to talk about Max Pain tonight, explain what it is, and show you what it looks like. I'm going to make this a quick one because it's actually 3 o'clock Eastern time. So the market's not closed yet, but I've got some things I've got to do. And so I wanted to get this in before I took off. As always, I am not a financial planner. Anything I say is meant for educational purposes only, and I do not make recommendations to buy or sell anything. Nobody knows which way the market is going, including me. So you have to make your own investment decisions. So Max Pain, what is it? Options strike price with the most open contracts, and thus the price that causes financial losses for the largest number of options holders at expiration. Simply put, the market makers do not want to pay out the premium for options. Options expire on Friday. So if the market has generally been trending higher, which it has, then you should expect it to potentially go lower the end of the week, Thursday, Friday, and even into the first day or two of the next week. That's basically what Max Pain is all about. Here's an image to give you an idea. So the idea is to try to get to the equilibrium point, the balance between puts and calls of options. So if the market has been higher, which means lots of people are buying calls on the right-hand side of this, then expect to see selling around expiration to bring those back towards the number of puts that are outstanding. And that means the market makers will not have to pay out all of this premium. On the other hand, if the market had been going lower, then you should expect buying towards the end, towards expiration date. And in that case, to remove some of the put premium to bring that more in line or equilibrium with the calls. So that's basically what Max Pain is. So the Max Pain price right here is $355. So if this, let's call that SPY. If SPY was selling for 402 over here, then you should expect selling to get it down to 355. It's basically the equilibrium point between all the call premium and all of the put premium. And that gives you a price that gives you the equilibrium for Max Pain. So that's basically how it works. So let's jump into it. I am going to show you some other things about the market here after I do the Max Pain portion. So stay tuned because it's very interesting. All right, let's take a look at the report. So before I do that, I want to do a shout out to Tom Bowley and EarningsBeats. This is where this report comes from. Tom does a lot of market research, market historical information, a lot of education on his site. His site is a really good site if you're interested in learning more about what he does. He has a blog, he has a live Trading Places Live that he does once a week where he actually goes live and shows you what he's looking at and actually executes some trades. And he's got the chart list that puts a lot of time into, him and his staff. This is where he compiles all of the stocks that have the strongest earnings. In this case, this was just updated on the 15th, so Saturday. 301 companies that have beat both earnings and revenues. There's also a accumulation distribution list. There's a short squeeze list, future earnings list, raised guidance list, and then one that puts all three of those together. In this case, there's only 26 company. But this is a really valuable resource. However, he also does the Max Pain report. So you can see right here, Max Pain report, and that's what I'm going to show you. So when I show you this is where it came from. It came from Tom Bowley's EarningsBeats site. If you're interested, I highly recommend you check it out. Go to EarningsBeats.com, and we'll take you into the portal. He does have a special running. So if you're interested, he's got a flash sale going right now. So if you're interested in what he does, then now's a good time. All right, so let's take a look at the report that he produced this week for Max Pain. Let's see. right here. So here's the max pain report. So I want to first make it clear that, remember, we're trying to get to the equilibrium point. In this case, the SPY right now closed on last Friday at 609. It's right now at, let's see what the SPY is at today, 612, almost 613. So it's a little higher than what it closed on Friday. Max pain at that point was 588. So that's the equilibrium point between puts and calls. That means it would have to decline about 3.5% in order to get to that equilibrium. In other words, get to the point where market makers don't have to pay out all of this premium. So there's the net call premium that's outstanding, $830 million. And I'm sure market makers would love for this to come down, at least get, some of that, allow them not to have to pay out some of that. But I want to be really clear that this does not mean that's the target price. That is not what it's used for. It's just used to give a general direction, potentially, of what the market might do as it gets close to options expiration on Friday. And usually it's Thursday, Friday, and Monday or Tuesday of the following week. So you can see that this implies that there are lots more call premium than there are put premium. So to get it to the equilibrium point, that means the market should sell off and have some of that call premium expire worthless by Friday. So there's the Qs down 3.5%, or the directional Q 3.5%, and Russell 2000. So here's some of the major stocks, and you can very quickly identify the big ones. So there's APP, Palantir. So max pain for Palantir is 76. So what that means is there are a lot, there's a ton of call options on Palantir right now. MicroStrategy, 16%, Netflix, 14%, Broadcom, etc. So you can see all of these all the way down. Gives you an idea of perhaps the direction. Celestica, 32% in order to have the puts and calls reach equilibrium. So those are all of the major ones. We can go down here, look at a few others. Cisco is only 7%, but these are directional cues. Not necessarily, that's definitely not the target price. That's not where it's going to go to. Just that the market may be selling towards the end of this week. That's not happening today. So just to be clear, the market's actually making new highs again today. We've got about 50 minutes left. If we get to the bottom, then this is the opposite. So these down here have more puts than they have calls. So you can see Astera Labs, they've got a lot more puts against them than they do calls. So to reach max pain in this case, the price would have to rise to 102 in order to make those equal. Microsoft and AMD are down here. Microsoft is pretty much flat. So it's got almost an equal number of puts and calls right now for Microsoft. AMD, of course, would have to come up to about 115. But this just gives you a sense for a directional. TTD, which had a terrible week after earnings, went all the way down to $80. I don't think it's a stretch for it to actually come back to 88, actually. So we'll write a couple of these down. We're going to actually look at these. To TTD, we'll look at, so that max pain price is 88.68. Let's let's just pick a couple more. Let's look at AMD just for fun. So that one needs to come to 115.50. And we'll go back up to the top and look at NVIDIA. Would have to come to 115.27. Palantir would have to come to 76, 78. There's no way that's going to happen. But again, this is just directional. And SPY and Qs, we'll look at those. So SPY would have to come to 588.61. And Q would have to come to 519.24. So that's Max Payne. Today is Wednesday. If this is going to play out, it likely will start sometime in the second part of tomorrow, in the afternoon, most likely on Thursday, and then carry into Friday and into the first couple of days of next week. So that's what Max Payne is all about. Let's go over here and take a look at a couple of stocks, just see what they're doing. We'll start with the SPY. So here's the SPY, and Max Payne is 588 on this. So it would have to come to all the way down here. There's 588 right there. So this would have to come down to there for equilibrium. Not likely to happen, but remember, this is directional. So the Q's 519 right there, just below the 50-day moving average. That's not out of the realm of possibility, but you can see it. Everything, these are making new highs again today, so probably won't happen. Let's look at Palantir. Palantir would need to come to 76, which is all the way down right here. We have to come all the way down there. Again, not likely to happen. That's below the 50-day, so probably not. There's a gap right there at 85, but directionally, I mean, it could come down to 100. Certainly, it's at 120 right now, but that's only 3 days away, so we'll see. NVIDIA, that one would come down to 115. That's all the way down here. So right down back at the lows, the recent lows. Again, not likely to happen for NVIDIA by Friday, but it could, certainly sell off down to the 50 or 21 day moving average around the 134 area. Again, this is a directional Q, and that's it. So that means we should look for the market to sell off on Thursday, Friday, and Monday. AMD would come up to 115. It's actually already at 115. So AMD is pretty much already satisfied its Max Payne today, hit it today. So that one didn't really have that far to go, actually. TTD, though, actually TTD doesn't have much farther to go now. TTD continues to go down. It's at 77.61 right now. So Max Payne for it is 88.68, which would be right about there. So it would have to get up into the gap up in here to hit Max Payne. And this one certainly looks like it's continuing to go lower. So let's look at it on a 30-minute chart. That's the sell-off right there. It's continuing to head lower. All right, so that's Max Payne. Basically, it's implying the market may decline. Usually today and the rest of the week going into options expiration is usually the worst 5 days of the month in most cases. So that certainly helps with Max Payne as well. But just keep that in mind. So we'll see. We'll see what happens. We'll talk about this again on Friday and take a look at what actually happened. All right, so that's Max Payne. I want to let's take a look at the market first, look at the dashboard, see what's going on. Dow coming down, S&P had a nice, right from the beginning in the mornings, just started going up. Started to pull back a little bit here in the afternoon, the last hour. We'll see. The NASDAQ 100, same thing, pulling back a little bit in the afternoon. NASDAQ also. Bonds, TLT, started off pretty good, but pulling back now, back down again. 10-year pulling back, 4.5 right now. Crypto, Bitcoin actually is having a good day. So Bitcoin is up there. Ethereum's having a good day as well. So that looks pretty good. The sectors today are mostly, technology is number four place, but most of them are defensive Communication services right in the middle, and discretionary at the bottom. The main industry groups, airlines is up there, automobiles. Anything else interesting? Not really. If we look at our top 10 list, ADIA up 21% today. HIMS another almost 20% today. Just keeps on moving higher. Gorilla Technology, this is one that just made the top 10 list about 2 weeks ago. Serve Robotics had a big sell-off after NVIDIA canceled their partnership, but now it's coming back very strong. SMCI just continues to go up. So SMCI is looking great. So those are the top 10. The bottom, Wix looks like they reported, didn't do well. Axon it's having a terrible day. It's actually at the lows right now, lows of the day, and they didn't have earnings, so I'm not sure what the news was on Axon, but they're selling off pretty handily. They're all the way at the bottom of the list. JFrog had a nice run after earnings and is basically consolidating right now. Affirm Holdings starting to pull back a little bit. So we'll have to watch the market as we get into the rest of the week, see what happens. Now, what I like to do, the last thing I want to show you is I have not updated the matrix, of course, because the market's not closed yet, but I will get this updated tonight. But I want to go to the charts page and show you the daily routine right here. I just want to show you a couple of things on here. So the weekly trend analysis is something that you should look at least once a week. And you can see down here, the long-term trend is still very healthy, but declining even as the market goes higher. This is for the S&P. The medium trend is declining as well. And you can see what happened back here in the beginning of 22. This is January of 22, where we had this big red bar right there, and the medium term drop below zero. So that's what we're looking for to see if the market is getting ready to actually roll over. That's not happening right now. Market actually is still making new highs, but keep an eye on this because this is declining. So this is a bearish divergence, and there's a lot of these lately that I've noticed, a lot of bearish divergences. So that's the trend analysis. These are all right here, things that you can look at each day. We look at the big picture for the S&P, shows us that it's still in a bearish wedge. Again, making new highs today. This typically breaks to the downside, but it has not happened yet. So there is no confirmation that these bearish signals are firing. I'm just pointing them out as a way to be prepared. Keltner charts will show you the extremes. So I'm looking at the S&P and all these. S&P is certainly not at an extreme. It's in the 2x ATR. When it gets up into the 3x ATR like it did back here, that's usually where it reverts to the mean and many times goes all the way back down to the bottom extreme. So right there and right here. In this case, it reverted to the mean, the blue line. In this case, it went all the way down to the bottom. We are not quite there yet. So there's still room for the market to move higher. So as it did today, and today it's making, if it closes where it is, it will make a new closing high today. So that actually doesn't look too bad. If we look at the 10-minute chart with the aggressive sectors, and there you can see, this is this week, Monday and Tuesday. Actually, Tuesday and Wednesday, because Monday we had off. This should be Tuesday's open. And you can see it pull back a little bit, but then starting the end of the day yesterday, it just started moving higher, and it's continuing to do so. With technology looking pretty good, discretionary underperforming, communication services underperforming. And if we look at the defensive charts right here, we'll see if they are, healthcare is slightly outperforming. This is for the week. So this solid, dashed red line is Monday's open, basically. Staples is the one, Staples and energy both, and utilities. All three of these are outperforming for the week so far. So it looks like defensive areas are the ones that are being rotated to. Let's look at sustainability ratios. This gives you a sense for the internals of the market. And what you can see is as the market has gone sideways, this is the S&P here, market has gone sideways and even up, making new highs today. Discretionary versus staples is declining. The NASDAQ versus the S&P is declining. Technology versus the S&P is declining. Turn this off. Growth versus value declining, and the Russell 2000 versus the NASDAQ is declining. So these are all signals that rotation is taking place out of growth and into value or defensive areas. This is what typically happens before the market rolls over. Wall Street, they can't sell everything at once. They have to do it slowly over time. And what they hope is that retail traders will prop the market up long enough that they can move their positions over to more defensive areas. And that looks like exactly what's happening right now. If we go back over here and look at, so those are sustainability ratios. You can look at breadth analysis. It's another important one. This is the advanced decline lines. Again, you can see we're making new highs up here. Advanced decline lines for the NASDAQ 100 actually looks very good. The New York Stock Exchange, however, even as the market makes new highs, it is not going back and making a new high. It has not made it back to its high back in December. Large cap advanced decline, again, even as the market hits fresh new highs, it is not back to the high. Mid caps are not back to the high. Small caps are not back to the high either. Even though they're moving up, these should be higher if the market is making new highs like that. This means that there's not much conviction. There's not a lot of conviction in these new highs that are being generated. So let's take a look under the breadth area again. Intermarket relationships. We can see the NASDAQ versus the S&P, same thing. Growth versus value, discretionary versus staples, mid cap versus the S&P, small cap versus the S&P. Definitely lower. All of these going lower. Also under, let's see, bullish percent index. We see that the bullish percent index, as the market is making new highs, is continuing to go lower. In fact, the S&P is actually accelerating lower right here. The NASDAQ 100 is hanging in there, but it's also declining slightly even as the market has hit new highs. So it doesn't look as bad as the S&P, but the S&P for sure these should be at least up to these previous highs back here, and it's definitely not doing that. So this is just giving you advance warning. These are the internals of the market. Usually things like moving averages and a lot of the indicators I've talked about are by definition lagging indicators, but these kinds of things can give you advance warning. That and also looking at things like negative divergence. The NYSE McClellan oscillator, this basically is an average of the advanced decline for the New York Stock Exchange. You can see it's been heading down as the market's going sideways and even hitting new highs. This should be way up here. Should be as high as what it was right here. Because the market is actually higher than it was here. This oscillator, basically an average of the advanced decline line, should be up here as well. And it's not. So that's showing weakness. And the bullish percent down here is still above 50. So that's good, but it's showing weakness still. The other one to look at is the 50 and the 200-day moving averages. So this shows you, number one, it shows this is the put-call ratio right here. So it's still starting to move higher, which means more puts. But when it gets below this pink line right here, that is very, very bullish. That's overly bullish. So that's usually where markets turn around, usually where you hit a high. We are not that bullish, although it is coming down again. Even though we're hitting new highs, there's still more puts than there were back here. So percentage of stocks above their 20-day, it was down below 50%. Right now, it is at 56%. Stocks above their 50-day was down around 50%. Right now, it's at almost 60. It's at 59.4. But the ones percent below the 200-day, it's at 63% right now. So again, you can see the trend. It's not so much the actual number, but the trend over time. As the market has been going higher, there have been fewer stocks making new 50-day highs and new 200-day highs. So again, the participation is not really there in the market right now. So having said that, if we look at the VIX is still pretty tame. So the VIX went down slightly. It's at 15 and a quarter. So as long as it's below 17, that's implying that the market's not really too concerned about a real sell-off or a crash or anything. However, a lot of the internals of the market are telling me that it may be preparing to do that at some point here in the future. So anyway, that's one way you can use a lot of these charts on here. We can look at the National Association of Investment Managers. That kind of explains what they are. And we can look at the weekly chart for that and see what they are doing. And right now they're becoming less bullish. They're not as bullish as they were here. When it goes above this 95% point, that's usually where tops form. You can see there, this is just before the top. It's not usually before it, not right at the top. So we hit it right here. And then we came down and actually going back up and making a new high once again. But the number of investment managers are becoming less bullish as well. So all of this is pointing to potentially that the market is getting ready to roll over, start to decline. That doesn't mean it's going to crash. It may just have a healthy pullback, probably needs to have a healthy pullback, but we'll see what happens. But I just wanted to point that out to everybody, just to be aware and be cautious. Over here, we'll take a look at the charts that I included yesterday. So the S&P right now, you'll see it's at a new high. Actually, it made a new high and now it's pulling back. It's still above, so far, still above these other highs back here, but it started to pull back here at the end of the day. We'll see how it ends when the day is over. The NASDAQ, probably the same thing. So NASDAQ now is definitely pulling back, and it's now showing a shooting star doji. So that right there could be a reversal if that continues into the close. And right now we are at 3:30, so we've got 30 minutes left for the close. We'll look at Bitcoin right here real quick. And there's Bitcoin, hasn't really been doing much today, but it's got a big squeeze down here. So, and momentum is moving higher. So it might be getting ready to make a move if the rest of the market cooperates. I also changed this a little bit, the S&P and Q. I changed it to equal weight rather than the cap weighted, just to give you a sense that the S&P is definitely underperforming the equal weighted NASDAQ. So the equal weighted NASDAQ actually looks pretty good. This basically levels the playing field from those large cap tech stocks, which make up about 50% of the Q. But now they're all treated equally in this case, and the same thing with the S&P over here. So the S&P now is underperforming while the NASDAQ is outperforming, and you actually would like to see both of those outperforming. All right, so I just wanted to point all that out to everyone. Hope you understand a little bit more about Max Payne. Looks like the market in general wants to go down, but doesn't mean it's going to crash. So we'll check this out again Friday and see what actually happened. For those that are interested, breakpointtrading.net. This is the website. You can get to the YouTube channel here and my weekly newsletter. I'm going to be putting some more things in about the internals of the market and some things that I found that should also cause concern. It's not just me saying this. There are a number of other really good traders out there that I follow that are showing the same things and implying the same things, to just be cautious and be aware of what's going on, that we are at significant highs right now, and it likely won't stay there. So invest accordingly. Move your stops up. Go to cash. Cash is also a position. I'm not telling you what to do or how to trade, but just want to point out some things that are happening internally to the market. All right. Thanks, everyone. Have a great night, and I will talk to you again tomorrow. Take care.